has issued a draft circular that seeks to harmonize regulations of housing finance companies with that of non-banking finance companies. Ankur Mishra, my colleague, is now joining us live to give us more details about what this circular really means. Ankur, take us through what this circular really means. I mean, it says that it seeks to harmonize regulations of housing finance companies with that of NBFCs.
Yes, NBFC, HFCs, that is housing finance companies, have a little different regulation if you compare it with NBFCs, and now Reserve Bank of India plans to harmonize both of them so that HFCs come closer to NBFCs. Now for that there has been certain directions from Reserve Bank of India, and it has been proposed that deposit taking HFCs should maintain 15% of liquid assets for taking public deposits, and this was 13% earlier. Now for NBFCs, this level is 15%, and Reserve Bank of India has prescribed the same level for housing finance companies. Also, housing finance companies needs to have full asset cover that is available for public deposits, and what happens if it falls below that threshold? They have to inform National Housing Bank for that, and if it is short of that liability, that needs to be immediately informed to the regulator. Apart from that, deposit taking housing finance companies should also maintain minimum investment grade rating for at least 1 year for continuing to take deposits, otherwise they will have to stop that. Apart from that, public deposits accepted or renewed by HFCs shall be repayable by 1 year or maximum 5 years as far as these draft guidelines are concerned. Now it will all depend what kind of comments Reserve Bank of India receives, and finally you will see these draft norms taking the shape of final regulations.
All right, thank you very much, Ankur, for joining us. So RBI issuing a draft circular that really seeks to harmonize regulations of housing finance companies with that of NBFCs. And one very crucial point as far as this story is concerned is that deposit-taking NBFCs will have to maintain 15% of liquid assets versus public deposits, against public deposits versus 13% earlier. But moving on to the other big